Most traders look at their charts backwards. They open up a 5-minute chart, see a pattern they like, and they trade it. Then they wonder why they keep getting stopped out, why their perfect setups keep failing, why they can't seem to get any momentum behind their trades. The reason is simple. They're trading in a vacuum. They have no context. Context is everything in this business. A breakout on a 5-minute chart means nothing if the daily chart is in a downtrend. A beautiful bullish pattern on the hourly means nothing if the weekly chart is hitting major resistance. You can't trade what's in front of you without understanding what's around you. That's where top-down analysis comes in. Top-down analysis means you start with the big picture and work your way down to your entry. You begin with the longest time frame relevant to your trading and systematically move to shorter time frames. Each level gives you information. Each level adds context. By the time you reach your trading time frame, you know exactly where you are in the larger structure. You're not guessing. You're not hoping. Let me tell you how I learned this lesson. Early in my career, I was quick. I could spot patterns forming on short-term charts faster than anyone. I'd see a breakout developing and I'd jump in immediately. Sometimes it worked, but more often, the trade would move a little bit my way and then reverse hard. I'd get stopped out and sit there confused. The pattern was right. The entry was right. What went wrong? What went wrong was I had no idea what the bigger picture was telling me. I was buying breakouts at the top of daily ranges. I was going long into weekly resistance. I was fighting larger trends because I couldn't see them. I was so focused on the trees that I couldn't see the forest, and it cost me a fortune before I figured it out. Once I learned to do top-down analysis, everything changed. My win rate improved dramatically. My losses got smaller because I could see when I was wrong faster. My winners got bigger because I was aligned with the larger trend. The same patterns I'd been trading suddenly worked better, simply because I was trading them in the right context. Here's how top-down analysis works in practice. Let's say you're a swing trader who holds positions for days to weeks. Your trading time frame is the hourly or 4-hour chart. That's where you'll time your entries and exits. But before you ever look at that chart, you start with the weekly. On the weekly chart, you're asking one question. What is the dominant trend? Is this stock in an uptrend, making higher highs and higher lows? Is it in a downtrend, making lower highs and lower lows? Or is it in no trend at all, just chopping around? This is the most important piece of information you can have. Everything else flows from this. If the weekly chart shows a clear uptrend, you now know you want to be a buyer. You're looking for long opportunities. You're looking to buy dips and pullbacks. You're not interested in shorting this stock unless you see clear evidence the trend is changing. The weekly trend is your bias. It's the current you're swimming with or against. If the weekly shows a downtrend, the opposite is true. You're looking for short opportunities. You want to sell rallies. You're not interested in buying unless you have a specific reason to think the trend is reversing. And if the weekly shows no clear trend, just sideways action, you're much more cautious. Sideways markets are dangerous. They chop you up. Unless you see a clear breakout forming, you might skip this stock entirely and find something with a cleaner trend. Now you move down to the daily chart. Here you're looking for structure within the weekly trend. If the weekly is in an uptrend, you want to see that the daily is respecting that trend. Is the daily making higher lows? Is it bouncing off support levels? Is it consolidating before pushing higher? You're looking for confirmation that the weekly trend is intact and healthy. You're also looking for where the stock is within its daily range. Is it at the bottom of the daily range, setting up a potential long? Is it at the top, extended and due for a pullback? Is it in the middle, giving you no clear edge? The daily chart tells you whether this is a good time to be looking for trades or whether you should wait. Let me give you a concrete example. Say the weekly chart shows a strong uptrend. Good. You want to be a buyer. Now you look at the daily. The daily chart shows the stock has pulled back over the past few days and is now testing a support level that's held multiple times. Volume is decreasing during the pullback, showing the selling is weak. The daily structure is telling you this could be a good spot to buy. Now you drop down to your trading time frame, let's say the 4-hour chart. Here you're looking for the specific entry signal. You see price holding at that daily support level. You see a bullish candlestick pattern forming. You see volume starting to pick up as buyers step in. This is your entry signal. But notice what you've done. You haven't just taken a pattern on the 4-hour chart. You've confirmed that pattern is aligned with the daily structure and the weekly trend. You're trading with the current, not against it. Compare this to the trader who just looks at the 4-hour chart, sees a bullish pattern, and buys. He has no idea the weekly is in a downtrend. He doesn't know the daily is at major resistance. His bullish pattern on the 4-hour might be real, but it's swimming upstream. The odds are against him and he doesn't even know it. This is why top-down analysis is so powerful. It stacks the odds in your favor. You're not just trading a pattern. You're trading a pattern that's confirmed by multiple time frames. When the weekly, daily, and 4-hour charts all agree, that's when you press. That's when you take larger positions. That's when the big money is made. Now let me talk about what happens when the time frames don't agree, because this is just as important. Sometimes you'll do your top-down analysis and you'll find conflicting signals. Maybe the weekly is in an uptrend but the daily just broke major support, or the daily looks great but the 4-hour is showing weakness. These conflicts are information. They're telling you to be careful. When I see conflicting signals across time frames, I do one of two things. Either I don't trade at all, or I trade much smaller size. If the weekly says go long but the daily is questionable, I might still take the trade but with half my normal position. The conflict tells me there's more uncertainty. More uncertainty means more risk. More risk means smaller size. Most traders do the opposite. They see conflicting signals and they convince themselves the time frame they like is the right one. They ignore the warning signs because they want to be in the trade. This is how you get destroyed. The market is telling you there's disagreement between different time horizons. That disagreement means the path of least resistance isn't clear. And when the path isn't clear, you should be cautious. Let me tell you about a time when ignoring conflicting time frames cost me. I was watching a stock that looked perfect on the daily chart. Beautiful uptrend, clean structure, consolidating at just the right spot. I was ready to buy. But I didn't check the weekly chart. If I had, I would have seen the stock was at major weekly resistance. The monthly chart showed an even clearer picture. This stock had tried to break through this level 3 times over the past 2 years and failed every time. I bought based on the daily chart. The stock did exactly what I expected for about 2 days. Then it hit that weekly resistance and died. Just stopped cold and started rolling over. I held on, convinced the daily trend would reassert itself. It didn't. The weekly resistance was too strong. By the time I admitted I was wrong, I'd given back 2 weeks of profits on that one trade. If I'd done proper top-down analysis, I would have seen that weekly resistance screaming at me. I either wouldn't have taken the trade, or I would have taken it with a much tighter stop and smaller size, knowing I was playing against a major resistance level. The daily chart wasn't wrong. It just wasn't the whole picture. Here's another critical aspect of top-down analysis. Support and resistance levels from higher time frames are more significant than levels from lower time frames. A support level on the weekly chart that's held for months is much more important than a support level on the hourly chart that formed yesterday. When you're doing your analysis, you need to mark these higher time frame levels on your charts. I keep weekly and daily support and resistance levels marked on all my charts, even when I'm trading intraday. Why? Because when price approaches these levels, I know something significant is about to happen. Either the level holds and price bounces, or it breaks and you get a major move. Either way, these are the spots where you need to pay attention. Most traders only look at levels on their trading time frame. They miss the big levels that really matter. Then they're surprised when their stock runs into resistance they didn't see coming, or when it bounces off support they didn't know existed. The higher time frame levels are like landmarks on a map. They tell you where you are and what obstacles lie ahead. Let me give you a specific process for top-down analysis that you can use. Start with the monthly chart if you're holding positions for weeks or months. Look at the monthly trend. Note any major support or resistance levels. Get the big picture context. What has this stock been doing over the past year or two? Move to the weekly chart. Confirm the monthly trend is intact, or note if there's a change developing. Identify weekly support and resistance. Look at where price is within the weekly range. Is it extended, or is there room to run? Move to the daily chart. Look at the daily trend within the context of the weekly and monthly. Identify daily support and resistance. Look at the daily structure. Is it setting up for a trade? Is it consolidating? Is it extended? Finally, move to your trading time frame, whether that's 4-hour, hourly, or even 15-minute. Look for your specific entry signal. But you're looking for that signal, knowing everything you learned from the higher time frames. You know the trend. You know where the major levels are. You know where you are in the larger structure. This process takes time, maybe 5 or 10 minutes per stock. But that time saves you from countless bad trades. It's the difference between shooting in the dark and shooting at a lit target. One is gambling. The other is trading with an edge. Now, some traders tell me they don't have time for all this analysis. They want to be quick. They want to react to what's happening right now. I understand the impulse. But quick decisions without context are just guesses. You might get lucky sometimes, but over time, you'll lose. The traders who last in this business, who build real wealth, they're the ones who do the work. They analyze, they prepare, they know their context before they risk their capital. Here's what happens when you make top-down analysis a habit. You start seeing opportunities others miss. You see when a short-term pullback in a long-term uptrend is a buying opportunity, not a reason to panic. You see when a short-term rally in a long-term downtrend is a selling opportunity, not a reversal. You develop what people call market sense or intuition, but it's not intuition. It's pattern recognition from seeing how price behaves across multiple time frames repeatedly. You also develop patience. When you do top-down analysis and nothing lines up, you don't force a trade. You wait. You know that forcing trades in poor setups is how you lose money. The market will always give you another opportunity, but only if you preserve your capital by staying out of trades where the context isn't right. I've learned that the best trades, the ones that make serious money, are the trades where everything lines up. The monthly is trending, the weekly confirms, the daily is setting up perfectly, and your trading time frame gives you the precise entry. When you see that alignment, that's when you load up. That's when you're aggressive. Because the market is practically screaming at you that this trade has a high probability of success. But you can only see that alignment if you're looking at all the time frames. If you're only looking at one chart, you're blind to the bigger picture. And trading blind is suicide. Let me end with this. Top-down analysis isn't complicated. Start high, work down. Check each time frame for trend, structure, and levels. Look for alignment or note conflicts. Make your trading decision based on the complete picture, not just the chart in front of your face. This simple process will improve your trading more than any indicator or pattern recognition skill ever could. The market rewards those who see clearly, those who understand context, those who know where they are in the larger structure before they risk their money. Top-down analysis gives you that clarity. It turns the chaos of price movement into a structured, understandable map, and with that map, you can navigate profitably through any market condition. I learned this lesson slowly and expensively. You don't have to. Start doing top-down analysis on every trade. Make it your routine. Before you enter any position, answer these questions. What's the higher time frame trend? Where am I in the structure? Are all time frames aligned? Do I have room to be wrong? If you can't answer these questions clearly, don't trade. Wait for a setup where you can. That discipline, that refusal to trade without context, that's what separates the professionals from the gamblers. And in this business, professionals eat and gamblers starve.